Hello everyone! In today's discussion, we're diving into the world of stock market taxes. Whether you're just starting out or looking to refine your understanding, this guide aims to unravel the complexities of taxes when it comes to investing in stocks. From gains and losses to dividends and interest income, we'll explore these aspects to help you navigate the tax landscape within the stock market. Let's explore these concepts together and make sense of how taxes play a role in your stock market ventures. In today's video, we are covering taxes on stocks explained for beginners. If you're in the stock market, then you must know about the taxes. It's so important about how to use the tax rules in your favor. So, we're gonna teach you what you have to do with the money that you make in the stock markets, money that you lose in the stock markets, your dividend income, your interest income, and how to reduce your taxes in the stock markets. Stock market taxes. Let's start with the basics. In the stock market, your taxes will be based off the calendar year, so we're talking about January 1st to December 31st. Your brokerage account will keep track of all your activity for the year. And this is going to include gains, losses, interest, dividends, etc. Now, we want you to be prepared, so we want to give you a timeline of the event so that you don't miss any important tax deadlines or documents. So, let's say that it's December 31st. It's the last day of the year, and then the day ends and then the year just ended. So, Happy New Year! It's now January 1st, and your brokerage account has until February 15th to give you a tax document that you need to report on your tax return. This tax document is called the Consolidated 1099. The Consolidated 1099 will include the 1099-B, which states how much money that you made or lost in the stock market that year. The 1099-INT states how much interest income that you earned that year in your brokerage account. And the 1099-DIV states how much dividend income that you earned that year in your brokerage accounts. Now, you would think that in this day and age, everything is computerized, right? So, why can't your brokerage accounts immediately generate your tax documents on January 1st? Like, what's up with that? So that's a good question, but there's actually a good reason why it cannot be done that quickly. It's because even though your tax period ends on December 31st, there are certain types of stock transactions that can retroactively affect your taxes. So, for example, let's say that the year 2023 ended and it's January 22nd of 2024. So, with certain transactions, what you do in January can affect your taxes in the previous year. One example is the wash sale rule. That's why brokerage accounts cannot immediately generate your tax documents on January 1st. So, you're most likely to get your 1099 tax document in early to mid-February, which should be enough time for you to finish your tax return by the April due date. So, that's an overview of how this all works. Now, let's go over the most common situations in the stock market. You will only pay taxes if you make money. If you lose money in the stock market, then you will not pay taxes. So, as a matter of fact, if you lose money in the stock market, then you will receive a tax deduction. Now, let me give you an example to clarify. Let's just say that you buy Tesla stock for $100 in January of 2023. And let's say that you sell it 1 month later in February of 2023 for $120. So congratulations, you made a gain of $20. You sold the stock for $120, but you will not pay taxes on the full sales price of $120. You will only pay taxes on your $20 of gain. So, how much will you pay in taxes? That's going to depend on which tax bracket you're in, and that depends on how much money that you make overall. If you're in the 10% tax bracket, then your $20 of gain will be taxed at a rate of 10%, which means that you will owe the IRS $2. You made a gain of $20. You need to pay $2 of taxes to the IRS. So, you came out ahead by $18. Now, here's what you must know to save yourself a lot in taxes. If you hold a stock for 1 year or less, and then you sell it for a gain, then you will pay regular tax rates. This is called short-term capital gains. So, it's just based on how long you hold the stock. 1 year or less is classified as short-term. If you're in the 10% tax bracket and you make money in the stock market, then you will pay a tax rate of 10% on your short-term capital gains. If you're in the 37% tax bracket and you make money in the stock market, then you will pay a tax rate of 37% on your short-term capital gains. But if you hold the stock for more than 1 year and then you sell it for a gain, then it will be classified as a long-term capital gain. So, it just depends on how long you hold the stock. Short-term is a year or less. Long-term is longer than a year. Long-term capital gains receive much better tax rates, and it doesn't matter which tax bracket you're in. Your tax treatment will be much better regardless. It is a game changer. So, let me explain. If you make a lot of money at your job and you're in the 37% tax bracket, your long-term capital gains will be taxed around 20%. If you're in the 25% tax bracket, your long-term capital gains will be taxed at 15%. If you're in the 10% tax bracket, your long-term capital gains will be taxed at a rate of 0%. So that's right, 0%. If you don't believe us, you can look up 0% long-term capital gains tax. Therefore, regardless of whichever tax rate that you're in, long-term capital gains will receive favorable tax treatment. This is going to save you a lot of money, especially if you're sitting on a big winner. And this leads to another important point that you must know. You only trigger a tax consequence when you close your position. So, let us explain. So let's just say that you bought a Microsoft stock in the year 2020 for $100. By the end of the year, by the end of 2020, the stock goes up from $100 to $130. But you didn't sell it. You're just holding on to it because you did not sell the stock and you did not close your position. You did not trigger a tax liability. And let's say that it's next year. So now, we're in 2021 and 2021 ends and Microsoft went up to $150. So congratulations, but you just held the stock. You still didn't sell it. Then it's going to be the same thing. You did not sell your stock. You did not realize the gain, which means that a tax consequence has not been triggered. So still, there's nothing to report on your tax return, and you don't have to pay any taxes yet because you haven't sold a position. You have not closed your position. And then let's say that we're now in the year 2022, and you finally decide to sell the stock for $180. Now, we'll tell you two things. One, your gain is $80. You saw the Microsoft stock for $180. You bought it for $100. So your gain is $80 and you will be taxed on your $80 of gain. The second thing is that your tax rates will be much better because, remember, you held onto the stock for longer than 1 year. And this makes it a long-term capital gain, and long-term capital gains receive much better tax rates. Okay, if you're still following along, then you're crushing it. But if you need clarification on anything we've covered so far, or if there's something that we haven't covered yet, please let us know in the comments down below. We're gonna try our best to help. Stock market losses. Let's talk about losing money in the stock market because it happens. When you make money in the stock market, you have to pay taxes. When you lose money in the stock market, the IRS gives you a tax deduction. And a tax deduction allows you to pay less taxes, which is a good thing. So let's be clear. Losing money in the stock market is bad. Try not to do that. But if you lose money, at least you get a tax deduction. When life throws lemons at you, you make lemonade. So use this to keep a positive attitude towards losing money in the stock market. At least you get a tax break. So, let's run through 3 examples of you losing money in the stock markets. Example number 1. You work a job, and at your job, you make $100,000 of taxable income. So congrats, you make 6 figures. You have all this extra money and you're like, I'm going to invest some money in the stock markets. And you buy $2,000 of Peloton stock, and your investment declines from $2,000 to $1,000 in the same year, and you don't sell it. By the end of the year, you just keep holding onto the stock, hoping that it recovers. You know what the tax consequence is? There is none because, remember, you didn't sell the stock. You did not close your position, so you did not realize your loss. Therefore, there is no tax consequence. Let's go through example number 2. It's going to be the same setup. You make $100,000 at your job. You buy $2,000 worth of Peloton stock. The stock declines to $1,000 and you can't take it anymore. The stock is stressing you out and you end up selling it in the same year for a $1,000 loss. In this scenario, you realize the loss of $1,000. But hey, you have to look at the bright side. You get a $1,000 tax deduction. So on your tax return, you make $100,000 as taxable income at your job. But now you get a $1,000 stock market loss to reduce your total taxable income. So on your tax return, your taxable income goes from $100,000 to $99,000. So hey, you save some money on your taxes. In example number 3, the same setup. You make $100,000 of income at your job, and let's say that you bought $20,000 of Peloton stock, like you went overboard. And let's just say that the stock fell in value from $20,000 to $10,000. You know, that sucks, but it happens. And you sold the stock and lost $10,000. Here's what happens. There's a rule that limits your losses per year. You can only use a maximum of $3,000 of losses per year as a tax deduction. So, if you lost $10,000 this year, you can take a $3,000 tax deduction this year, and then your tax return would look like this. Taxable wage income, $100,000. Capital losses, $3,000. Taxable income, $97,000. You'd have unused losses of $7,000. So, the $7,000 of remaining losses would carry forward into the future. Don't worry, even though you can't use all of your losses as a tax deduction this year, you can use them in future years. So, you don't lose your losses, they carry forward. And if you don't use all your losses next year, then the losses just keep carrying forward until you're able to claim them all in full. Now, we have to clarify this. This is so important. Do not be confused. If you lost $10,000 on Peloton stock, but you made $10,000 on Walmart stock, then you can use the entire $10,000 loss from Peloton to offset the $10,000 Walmart gain. So, they net together. The $3,000 limitation is when you lost money in the stock market overall. And $3,000 is the maximum tax deduction that you can claim to lower your other taxable income, such as taxable income that you made at your job. To clarify, if you made a gain of $10,000 on Walmart stock but you lost $15,000 on Peloton stock, that means that you lost $5,000 in the stock market overall. You can use $3,000 of that as a tax deduction to reduce your wage income. So, you lost $5,000 in the stock market overall. You can use $3,000 as a tax deduction that year, and then your $2,000 of remaining losses will carry forward to next year. Now, let's cover your tax obligation on your dividend income and your interest income. This is very easy, but we don't want you to overlook this. So remember, around early February, you should receive your tax document from your brokerage account. This tax form is called the Consolidated 1099, and this will tell you how much money that you made from interest and dividends for the tax year that just ended. and you have to report this information on your tax return, but it's straightforward to do. If you're filing your tax return yourself with a do-it-yourself software, then you just simply look at your 1099 tax form and then type into the software the figures that your software needs. But in today's modern society, many tax software allows you to directly connect to your brokerage accounts, and the software will automatically retrieve the relevant tax information that your tax return needs. And just for your information, you may have interest income in your stock market accounts because you may be earning interest on money that you're not using within your accounts. If you get paid interest, it's listed on your 1099 tax documents, and you have to report it on your tax return. But that's very straightforward to do. Your interest income will be taxed at your regular tax rates. You will not receive any special treatments on your interest income. And here's a little extra information on dividends. So, some of your stocks may pay dividends. It's listed on your 1099 tax document, and you report it on your tax return. Some of your dividends may be taxed at your regular rates, and these are called ordinary dividends. Some of your dividends may be taxed at lower rates, and these are called qualified dividends. So, it just depends on the classification of the dividends. We're not going to get into that today. On your 1099 tax document, it will separately list out your qualified dividends. But long story short, be on the lookout for your 1099 tax document by mid-February. Use that information for your tax software. If you're self-preparing your return, if you're using an accountant, give them the consolidated 1099 tax documents. If you do not report your 1099 activity, you will most likely result in an IRS letter unless your activity is extremely minimal. Again, this was a beginner's guide to taxes in the stock markets. If you have intermediate or advanced questions, reach out to your local CPA. We intentionally did not go into the details of estimated tax payments, equity options, commodities, foreign tax credits, etc. because we don't want to scare beginners and also because those issues will not be applicable to most people. If you found this information valuable, check out some of the other content on this channel. Thank you so much for all the support. Please subscribe and always remember, financial freedom starts with a playful mindset. Catch you in the next video. Cheers!